If you've saved $10,000 and you're ready to start investing it, then congratulations, you're in the right place. But even if you haven't, this video is going to be really useful for you to know exactly where to put your money and how to invest it to get the maximum returns you could possibly get. Which brings us to the big question. Is it possible for us to turn $10,000 into $1 million or maybe even more? And this might surprise you, but the answer is yes, it technically is possible. However though, the odds of that happening is a whole different story altogether. So while we may not be necessarily looking to turn our 10 grand into a cool million right this second, there are many steps you could take to bring you closer towards the goal of achieving financial freedom. And the first step you gotta take is to pay off any high interest debt that you might have. This is the first and most important step to take before you even begin to invest your money, because picture this, imagine your wealth being a bucket, and if that bucket has leaks in it, then no matter how much water you fill into that bucket, it's all eventually going to keep leaking out. So before you even look to add more water to the bucket, you've got to plug the leaks and seal it up so that none of the water that you add would end up being wasted. Only instead of water, we're talking about your hard-earned money here, and any high interest debt that you have are sort of like leaks in your wealth bucket. According to the CNBC article, any debt with an interest rate of 8% or higher could be considered a high interest debt. So for example, if you've taken out any personal loans or have credit card debt, which is one of the highest interest rates at over 22%, then you have to make it a priority to clear it off as quickly as possible. You could use different methods to clear off debt, such as the snowball method, where you prioritize the debt with the lowest outstanding balance first, regardless of the interest rate, just to be able to completely clear it off and pay it off fully. Or you could go with the avalanche method, where instead of the snowball method, you prioritize the debt with the highest interest rate. This is the method that I would recommend because the high interest debt accounts are the ones that are costing you the most money. Now, once you've paid off all your high interest debt, this should go without saying, but you have to stop incurring more debt because otherwise, you'll just end up right back in the same spot as you were in. If you ever find yourself struggling with somehow always getting yourself into debt, or if you just struggle with managing your money, then I would highly recommend for you to read this book right here called The Psychology of Money. This is one of my all-time favorite books on this subject because it highlights the many ways we behave and think about money, which is really interesting because all of us have a unique view of the world based on different factors like our childhood and how we were raised, our egos, the marketing messages that we're exposed to. So our view of the world and our view of money is colored by the life experiences that we've had. Alright, now coming back to the topic of investing. After you've cleared off your high interest debt, you've got to make sure to set aside your emergency funds. According to financial experts, you should set aside 3 to 6 months worth of expenses as your emergency fund so that if anything would have happened in this time, you'll be able to tide through it with these funds set aside. And on this note, it's important to remember that, especially for you as a new beginner investor, you should always only invest money that you're willing to lose if you were forced to lose it in the worst case scenario. Don't be one of those people who go all in and dump their rent money or their entire life savings into a certain crypto coin just because they heard that it's gonna rise to the moon, only to lose everything. Okay, so you've got your high interest debt paid and you've set aside 3 to 6 months worth of expenses in an emergency fund. Now, let's talk about the ways that I would recommend investing your first $10,000. Starting off at the top will be the simplest way to invest your 10 G's, and that is to invest in an index fund or exchange traded fund, commonly referred to as an ETF. An ETF is basically a pooled investment of a basket of stocks that tracks a particular index. For example, there's the SPY, which is an ETF that tracks the performance of the S&P 500 index. So which means instead of you having to go through dozens of financial statements to pick what stocks to invest in, you can simply buy a share of the SPY ETF. And that way, you get instant diversification and get to sort of invest in a little bit of each of the 500 biggest companies in the US that is tracked on the S&P 500 index. It's important not to get it confused though. The S&P 500 index is merely an index, and it serves to track the performance of the 500 biggest companies in America. Just like there are other indexes to track different countries' economies, different market sectors like the Dow Jones Index, the NASDAQ 100, etc. But the thing is, we're not actually able to invest directly into the index because it's merely there to track the performance of the companies that's in it. So instead, we can buy shares of an ETF that's designed to mimic the price movements of that index. So for the S&P 500 index, we can invest in ETFs such as the SPY, VOO, or IVV. These are different ETFs, but they all serve to track the movements of the S&P 500. When it comes to choosing which ETF to invest in, it's important to pick one with the lowest cost or expense ratio, which is basically how much of a fund's assets are used for their operating expenses. One of the cheaper options would be to invest in the IVV or VOO ETF, which both has an expense ratio of just 0.03% compared to SPY, which has a 0.09 expense ratio. To buy an ETF is really simple. You can do it from any stock brokerage app like Robinhood, Thinkorswim, Moomoo, or Interactive Brokers. The one that I currently use and would recommend is Webull, primarily because of its low fees, and I personally like the user interface of both the desktop and the mobile app. All you gotta do is to create your account with the link below, then fund your account, and once you've got it all set, search for VOO inside of Webull and click on Buy on the trade panel. It's really that simple. Now, let's take a look at how much we could potentially earn by investing in an S&P 500 ETF. If we invested our money 1 year ago, we would have netted a return of over 17% in the last year. However, this isn't always the case because the market's always fluctuating, so for a better estimate, let's look at a 10-year annualized return, which is still a very impressive 9.48%. Now, this is great for a completely passive investment where all you gotta do is to buy the ETF and then just leave it to do its work. Plus, with VOO, you'll also get paid dividends on top of your capital growth. But realistically though, if we were to look at the actual dollar amount, our investment of $10,000 would merely gain just about $900 in a year, based on a return of 9%, which isn't very much money. So it largely depends on your investment goals and your risk appetite. If you're someone who's looking for a safe investment option to stash your money away and make it grow, then investing in an ETF would be suitable for you. But if you're looking to get higher gains in a shorter amount of time, then investing in individual stocks might be the better option. Investing in stocks obviously comes with a lot more risk, and you're gonna have to spend a little bit more time learning about the individual companies and doing your own research on them. But you'll definitely get to enjoy much higher gains on them if you're able to pick the right stocks and buy them at the right time. For example here, if you had invested $10,000 into Apple 5 years ago, then you would now have turned it to over $45,000. Similarly, if you had invested $10,000 in Tesla stock 5 years ago, you would have now almost 10x'd it into $100,000. When people talk about investing returns, they're usually referring to these kinds of numbers, but remember that not all companies could get you returns like Apple and Tesla has over the last 5 years. And even then, these companies may not necessarily be able to generate such high returns over and over again in future. Now, the way that I recommend finding the best stocks to invest in are to look at the ETFs that we talked about earlier and see which stocks make up a large portion of their holdings. So with the VOO, we can see that the companies that make up the largest portion of the fund are stocks like Apple, Microsoft, Amazon, Nvidia, for example. And so when you're deciding on a stock to invest in, this could be kind of like a shortcut for you instead of having to do all the research by yourself. One thing you got to take note of though is the timing that you choose to buy the stock, because that could make quite a difference in the amount of returns that you could expect. So while most retail investors would chase a stock that's already rallying, I would recommend buying stocks whenever there's a dip. But if you don't want to have to bother with looking at the stock's charts, then a simple way to do this is by referring to the Fear and Greed Index. This basically measures the average sentiment of the market at the current moment, and so when the index is showing fear, then this will be a great time for you to buy the stock so that you can get it at a better price than if, say, you were to buy it when the index is in the greed area. Now, if all this sounds too complex or complicated for you, but you still want to have an option that could generate higher returns rather than just investing in an ETF, then the next method might be a good choice, and that is to invest using a robo-advisor. A robo-advisor is an investing tool that uses special software and algorithms to create and manage investment portfolios for you. But don't worry, the investment strategies behind them are still designed by actual people, actual financial professionals. It's just the day-to-day management of the portfolio that's handled by the system. So unlike traditional investment management companies that charge really high fees and require a large minimum balance in their account, robo-advisors have much more affordable fees and usually have low or even no minimum balance required. Typically, you get started by answering a few simple questions so that it can understand more about your investment goals and risk tolerance. So whether you're saving for college expenses or for a home down payment, or if you're just investing for your retirement, the robo-advisor will build a new, diversified portfolio based on the answers you provide according to the goals and risk tolerance indicated. And once the portfolio is up, the robo-advisor maintains the correct asset allocation and rebalances the holdings as needed so that you don't have to do anything. Most of these robo-advisor platforms would include tools and visuals to help you track your progress and allow you to add additional funds if you choose to. One of the robo-advisors that you can consider checking out is this one called Betterment. It's got over 56,000 reviews and has over $40 billion worth of assets under its management. All you have to do is to go on over to their website, just answer a few simple questions, and you'll be on your way to starting what could possibly be the simplest way to invest your money. Whether you're a student or if you're working or retired, they've got a customized plan just for you. Now, if you're looking for alternative options to invest your money other than in the stock market, whether it be via ETFs, investing directly in stocks, or using a robo-advisor, then you could actually consider investing in real estate. Of course, with just $10,000, it's not likely that you'll be able to afford buying an actual rental property, but you could easily invest in something like a REIT, or real estate investment trust. A REIT is basically just a company that owns or manages income generating real estate. So kind of like an index fund, a REIT pulls the money from investors and manages the real estate investments, allowing individual investors like you and me to earn dividends from real estate investments without having to buy the actual properties itself. There are REITs that focuses on different types of real estate properties like apartment buildings, hotels, medical facilities, offices, and retail spaces. REITs are publicly traded companies, so you can purchase it just like buying a stock using your trading brokerage app. And this means, unlike buying an actual physical piece of real estate, you won't need a very big capital and you get liquidity, meaning if you decide to sell the stock, then you can pretty much do it quickly whenever you choose. One REIT that you could consider investing in is the American Tower Corp, which operates the world's largest independent portfolio of wireless communications and broadcast towers. And they've got an annual dividend yield of 3.51%. Another REIT that you could consider is the Simon Property Group. They're a REIT that focuses on retail spaces and malls, and they pay an annual 6.58% in dividends, which really isn't too bad. The thing to note about investing in REITs is that we're mainly looking at the dividend yield, as it may or may not bring high growth in the value of the REIT itself, unlike investing in other stocks. In fact, the value of some REITs could go down over time, and that would erode the value of your initial investment. So when investing in a REIT, make sure to take that into consideration. Another alternative that you could consider is to use something like Fundrise, which is a platform that allows you to invest in various real estate properties with low fees. And you could actually get started with as little as $10. It's kind of like the robo-advisor we talked about earlier, but instead of stocks, Fundrise allows you to invest in actual real estate properties. Well, in fractions of it, of course. I'll leave a link to it down below in the description for you guys to check out if you're interested. So with all the things we've talked about so far, of course, this isn't an exhaustive list. There are definitely more ways that you could invest your money, like with starting a business, for example. But for me personally, I believe that taking the most simple approach sometimes could be the best way to get started, especially if you're new to investing. For me, if I were just starting out and only had $10,000 to invest with, I would go with the option of just investing it in an index fund. And then subsequently, when I have more money saved or set aside later on, then I would consider looking at the other alternatives. Now, if you found value from this video, please drop a like down below. And if you want to see more videos about making money and growing your money, then make sure to hit subscribe too. But for now, thanks so much for watching, and I'll see you in the next one.